Hi there, everyone, and welcome to another edition of On Track. I'm Rob McGregor, and I've got all the news and latest information right up to today, the 27th of July, including the latest RBA inflation announcement, just hot off the press. And we've got our performance numbers to the end of June, along with a look at markets to the end of June, which completes the financial year, obviously. Before I get into it, just a quick warning. This video is prepared for clients of McGregor Wealth Management, particularly those using our CARE investment methodology and CARE portfolios. For anyone else who's tuning in, you're welcome to get as much out of this as you can, but you should not act on any information here without seeking advice that's specific to your own circumstances. Today, as always, I'm going to cover the latest economic news, put it into context about what the market's doing. I'm going to talk about the returns, and I'm going to focus in again on interest rates and inflation because that's a hot topic. And I'm going to talk about lead and lag indicators, and I'll get to that shortly. Some of the news: share markets have gently bounced back in the last couple of weeks, slowly, but certainly started to head back in the right direction. So interest rates have continued to rise, particularly from the RBA as they fight inflation. I'll dive deep into rates in a few of the slides here, but you can see on the table here, we've had, when you look at the RBA cash rate, in the last 2 months, it's gone from 0.35 to 0.85 to 1.35, so up 1%. If you go down the bottom to variable mortgage rates, you'll see they're up 1% as well. And term deposits up all of a sudden a healthy 3.35 on 1 year. You can now get about 3.5 to almost 4% on 2, 3, and 4 years. That is obviously locking your money up for a while. And yeah, that orange shaded number there is the RBA's announcement or the ABS's announcement of inflation today at 6.1% annually. So that means prices have gone up on average in the last year 6.1%. And that's a whole variety of some up, some down. But that's the number everyone's been waiting for. The governor of the Reserve Bank had said he probably thought it might get to 7.1. The bank economists were talking 6.6 to 7. So the number's actually better than expected. And we saw the stock market bounce and bond prices fall. So both indications that the market likes that number. It's when a number's less bad than people expect, it's actually good. And the reason the reason the markets are starting to come up a bit and steady a bit is because some of the core inputs into inflation are starting to come down. Two of the charts here, crude oil and lumber, you can see prices have come off their post, well, the start of the war peak, at the start of the Ukraine war. Lots of commodities hit a peak price. These commodities feed into inflation. So oil feeds into inflation, cost of timber feeds into inflation. And I'll feature some more of these in a short while. But what we're starting to see is some falling prices, and that has the impact of decreasing inflation as the numbers come out. But it does take a few months, and that's why I'll talk about the lead and lag indicators. Probably markets have come back. I'll take you through the numbers. It's just slightly. My anecdotal evidence of talking to you guys, all the clients and other people that are in the market, is it's just moving back to a more normal market where it can take 2 to 4 months to sell a property. Prices are off the boil, but they're still pretty solid. When I show you the numbers, they're not exactly in great decline. They're down a fraction. Sydney and Melbourne, they're still up in Adelaide and Perth, but it's still strong over the whole year for Southeast Queensland. And I'll go through those numbers shortly. World's opening up. I'll go through some immigration figures again, some travel figures, but looks like we're back to about 50% travel when I just look at overseas arrivals and departures. I've been traveling a lot the last week with some investment committee commitments, and the airports are busy. They're suffering a bit. 3 out of my 4 flights in the last week were delayed, on average an hour and a half each. And it's just for the airlines. They're suffering the same as every other workplace, and they've got people who are sick, and you can't fly a plane without a full crew. So when they don't have the staff numbers, they've just got to cancel planes or shuffle and delay. So there's still a bit of grief out there for flying. We're not quite back to normal, but certainly people are keen and hungry and traveling. And we're just starting off the profit season, both here in Australia and the US. So it's going to give us some numbers on what the profits of companies were for the last 12 months. Now, once again, that'll be a lag indicator. So it's telling us what's happened. So the market only jumps at news that's unexpected, but they also have a look for guidance. So as companies announce their profit, they'll obviously talk about their prospects. So the market will be looking to catch the mood from the company's reporting. So it should be an interesting profit season. And no doubt we'll talk about that next month. Around the world in this wonderful little dashboard that's probably too busy for most of you, but trading economics, we see some good stuff. I note today the International Monetary Fund downgraded world growth assumptions. They're often last to the party, but and fairly conservative. But we've still got growth in the world. Current growth rates in the US at 3.5. Australia about 3.3. Interesting enough, Europe a bit higher than that. At about 5, but some of that is catching up from some of the shutdowns still. The big red numbers here are around inflation. So those numbers are still high-ish. It's interesting, Australia only came in at 6.1%. It's certainly better than Europe. It's better than the US, better than our friends in New Zealand, and pretty much up there. The only others that are low, France, South Korea. We'll see how the numbers pan out. The good news around the world is, for most countries, is unemployment's relatively low. So that's a good indicator for the fact that people have jobs, they can pay their mortgages. We might all grumble a bit with prices higher, but a lot of those impacts are coming out, which I'll talk about in a minute. We've still got big government deficits, and that is one of the issues as interest rates rise back to the normal levels, which we're now seeing, is that governments servicing those debts have got to pay a bigger interest bill, which also goes in the annual government budget deficit. We don't have this new government, the Albanese government, doing their budget till October in the mid-year economic forecast. Because the election was held in May, we effectively didn't get a proper budget. We just got a pre-election budget from the previous government, but so it will be interesting to see. Generally, incoming governments only have 1 year to take tough decisions, because we've got a 3-year election cycle in Australia. They're certainly not going to be making tough decisions closer to election time. They're more making popular decisions. So we may see some tough decisions come up in that budget. We'll see. That'll be a good thing. Not always popular, but ultimately you've got to run reasonable budget conditions and not allow the country to get too much in debt. Australia's debt relative to the rest of the world is pretty manageable. We're at about 24% of our GDP, while the US is at 137% of the GDP. GDP is just the earnings of that country. So it's like an individual who had 100,000 of earnings. For us, it's like we've only got 24,000 of debt. But for America, it's 137% of that. And for Japan, 266. So we're in reasonable shape. But there's still work to be done by lots of countries around the world. Returns are in, and it's interesting for returns across the industry, and I'll talk about some of the broader indexes. We'll all close the year at negative, and I'll work through the asset class returns, but it's pretty much been the first year since 1994 where all asset classes are down. Everything from bonds to gold to property trusts. The only thing that isn't, by the way, is residential property. So it's still up for the year, which I'll talk through. But in terms of portfolio type assets, so we're seeing here, our balance returns down about 5, and growth and high growth down about 6 for the year. Those returns, we don't love negative returns, of course, but they're not as bad as many, particularly those that copped it more from bonds. And I'll talk through some of the comparisons. And a long-term return is still sitting in the range that we would expect. And very careful, you've got to always be careful of measuring long-term returns when you're in what I call the ditch. So when you're in a downturn, if you measure returns at that point, they're always below average by definition. But as we recover back to the prices pre the downturn, they go kind of back to normal. So very careful about measuring during the ditch, but also making decisions based on looking in the rear vision mirror. So when we look at returns back for the last 12 months, they are absolutely the last 12 months. So it's dry cement. The returns that we'll get will have nothing to do with the returns that we've already got. And in July, we're already seeing an uptick in the market. And we're cautiously confident that we'll see that continue. There's always things that can go wrong. The world's focusing in on inflation at the moment. If inflation looks more persistent rather than temporary, that may continue to hurt markets, particularly if interest rates have to go up a lot. The bias I want to talk about today is loss aversion. I haven't got the definition here, but it's really simple. We as human beings are 3 times more scared of a loss of the same amount as a gain. So they've done tests on people, and when they've got a decision that might result in a $100 gain or a $100 loss, they're 3 times more cautious of the loss, even though it's a 50-50 probability. So loss aversion can mean some people, and not our clients, can make bad decisions when markets are down based on fear, and that fear is what drives these Delbar numbers that says the average equity investor only received a return in the last 30 years of 2.36%, while the average equity return was in fact let me get these numbers right. The average equity investor 7.13%, whereas the market was 10.65%. So that meant the difference for someone between, with 100,000 investment over that 30 years, instead of getting $2 million if they just bought it and left it in US shares, they only received just over a third of that, 789,000, because of their zigging and zagging, selling when markets are down, etc. And one of the behavioural biases that drives that is loss aversion. I kept this one in from last round because I just want to remind ourselves that this downturn we've had, and it's now turned the corner. You'll see in that chart, the market's on the way up. When I recorded this time last month, the market was still heading down. It's always more scary when it's heading straight down because you can't see it sort of bouncing back, but we're now heading back up. But just one of 7 downturns we've had since GFC, all of them which we cover, all of them caused by different things. And all of them which are just the price we pay for getting good long-term returns. You can't expect to get, or we shouldn't expect to get, 7 to 9% good quality long-term returns without paying the price, which is the occasional bit of volatility. Now let's have a look at yield curves. This is last month, and I want to put it in to show what's happened. So last month, you'll see Australian 10-year bonds had crept up to nearly 4%. And US bonds had crept up to 3.25%. Right now, when we look at them, they've fallen. So this shows it in a different way. Whereas in the previous month, rates had increased. The green line shows where it is last month. They've now dropped. So Australian 10-year bonds have come back to about that 3.4. The US has come back below 3 for the 10-year bonds. So we're now back in more normal. We think the bond markets are stabilising. That's the bonds markets saying they think long-term inflation is not going to be an issue. If they thought long-term inflation was going to be an issue, we'd see much higher long-term bonds. So the bond markets, which is one of the biggest investment markets in the world, with some of the smartest money, so to speak, in there, is effectively saying, yep, I don't think inflation is going to blow out. And this is getting back into the more normal range, of around that 3%. Now, I talked before about lead and lag indicators, and just explain what I mean. A lead indicator is like looking through your windshield at where you're driving, and a lag indicator is looking through the rear vision mirror. So when the inflation number came out today, as it did 2 hours ago at 6.1%, it was saying that was inflation to the end of June. So that was what has happened. That is over. It's not a prediction of what's going to happen this year. That is completely up to what happens this year. So it's a historical event. It's a lag indicator. It tells us what happened. Whereas lead indicators tell us what's happening now, and they give us some clues as to what might happen. So when we look at some of the prices of stuff, so we've got across the top here, and crude oil, as I said, has dropped from its and the war, the Ukraine war peaks were back around here. So, oil's dropped about 20%. As that feeds into the price at the pump, which isn't instant because refiners take a bit of a profit, they take their time putting the prices down, but it will happen eventually. That'll flow through into inflation numbers. And yeah, we see down the bottom here, the price of wheat has dropped substantially. It went through the roof in response to the Ukraine war. That's come out again a bit now. We've got the price of lumber down the bottom here. So that's timber and steel up the top. So both really important inputs in the cost of building. And you've heard your friends, you've heard people talk about how much building costs have gone up. Well, the inputs into that now are coming down. Once again, we won't see that come through in the numbers until even 6 months away, when we're hearing about what happened at the end of the September quarter and then at the end of the December quarter. So the RBA will be looking at these numbers when they report their interest rate decision this month. The devil will be in the detail, not so much what they do, because the market fully expects them to raise again, but it'll be in the words in their report, which most people don't read, but we will certainly be reading and passing on. And the last two here are gold on the top right-hand corner. Gold is traditionally something that goes up when the market's scared of inflation. We saw a bit of that last year with the war. Fear of inflation, gold went up, but that's wound back completely now. Gold's actually lower than it was a year ago. So the gold market is saying, we don't think inflation's a problem. If it was, gold would be much, much higher. And the last one is the cost of shipping dry goods, or the Baltic Dry Index. So this is the supply chain where we saw the cost, and this is a 5-year chart. So during COVID, which is about here, we saw that cost was way, way down, and we've seen it go up, literally a fortune during the COVID period, and it's starting to come down now. It's spiked back up again with the war and shutdowns in Shanghai, but it's easing back down again. And that cost of transporting goods around the world flows into the price of everything. So all the lead indicators are starting to show costs of things are coming down. That won't flow into the lag indicator, which is the inflation number, potentially till February next year, and we see the number to the end of December. But the RBA, the Federal Reserve, they're all looking at these, and that will lead them, hopefully, to not make crazy decisions around interest rates. So what's happened to returns across the board? So this is extracts from a table from Morningstar, who put together returns on different asset classes. And you can see here, for the first time since '94, we've had share markets go down and the bond markets go down. So someone who was invested in Australian bonds, just index, saw their portfolio go down about 10.5% last year, 9% of that, and that's the last year to 30 June, 9% of that was in the last 6 months, so from December to June. So that's a massive drop, and that's caused simply by interest rates on bonds getting back to normal, going from 1% to 3%, drives that completely. We saw international bonds the same, worse. So minus 16%, so capital loss of 16 or 17% for bonds over that 12 months period. And you'll see how that's flown through to what Morningstar calls target asset allocation indices. So their balanced index down about 8%. As I said, we're down about 5%. So we're less bad by about 3%. I know that still doesn't put smiles on your faces, but it's good to be less bad in these timings. So we quite clearly didn't have the same level of long-term bonds in portfolios, which has helped our returns. And that was a very deliberate strategy because we thought it was inevitable that at some stage bond prices would get back to normal, and that would result in some capital losses. And you see there the other ones, I haven't circled, but Australian shares over that 1 year, large cap shares down about 6%, and small cap shares down about 19%, and international shares down around 17%. So minus 5% in that market to minus 6% for most of our investors. Not as bad as it could have been. Hopefully, the good has already started. July's looking like an up month, and we'll get some decent returns. We're cautiously optimistic as long as none of the black clouds break over. As always, our market context. We use our framework of the boom bust wall of worry. We're very much in the wall of worry at the moment. We're certainly not in a boom. It looks like we're certainly not in a bust, just one of those corrections. They're the downturns of less than 20%. we still have our dial in around fair value, and we may bring that back a bit. But all that means is for new money that's coming through, if someone's sold a property or they're retiring now or they've got an inheritance, we're investing about 70% of that upfront and the balance over the next 3 months. When prices were high, say a year ago, we were spreading that over 12 months. And that just adjusts the timing. We never use this dial to say, let's get in or get out. We do use it around rebalancing. So anyone that needs the portfolio's rebalanced at the moment, we're waiting until markets recover, which is why the reserves exist in the first place. I just thought I'd talk about the mess it up briefly here, but mess it up's the acronym about how people don't get their investing right. And the media just so wants inflation to be a thing. You've seen all the reports in the news, the $10 lettuce. They're looking for stories of people that can't afford their mortgages, when the fact is most Australians can. Most Australians have saved during the last 3 years. They kind of knew that they'd be needing some money. There'll be some that won't, and that's always sad. But we've literally got 3.5% unemployment. So the Australian market is very good, but you'll see a current affair, you'll see the news channels trying to find hard luck stories just to make it sound really bad. And there's always, my advice is turn it off, look out the window. Life's not that bad, although we've had the sun's out today in Noosa. It's been a rainy winter for the most part, but not as bad as certainly economically as the media's making out. And the media loves reporting those lag indicators, by the way. So you watch tonight, you watch the next few days, they're going to be saying inflation is at 6.1% instead of saying inflation was 6.1% for the last 12 months. And they'll be finding stories that will make it sound like that's getting worse and that interest rates are going to go through the roof, when in fact interest rates fell slightly. Long-term bond rates fell slightly on that news because it was better than expected. I won't go through that. I'll talk about market returns, but the Aussie share market down about 8-9% for the last 12 months. Still incredibly good long-term returns. You'll see in the bottom right-hand corner the growth of $10,000, up to about 26,000 over that period of time. You see the varying returns for big companies, anywhere from plus 20% for National Australia Bank for the last year to minus 12 for ANZ. Such a big difference between two banks. Plus 46% for Westpac, minus 10 for Wesfarmers. So once again, this points out that incredible importance of diversifying, of not owning just a handful of shares. US shares actually up 5% for the year. For us, that was boosted by the Aussie dollar dropping to about 69 cents. So as I've said before, when we invest in overseas shares, when the US dollar, Aussie dollar drops, so when we go down to say 69 cents like we have from 75, our holdings in US shares are protected by that drop. So given that when most crises happen, the Aussie dollar tends to fall, it actually puts a floor under our US shareholdings, which is one of the reasons diversification works so well for Aussies, because we do our exchange rate tends to go the opposite way of the world's fortunes. So it gives us some good balancing out there. US small cap shares, they're more like Australian shares, down about 9-10% for the 12 months, but still incredible return. If you invested as we do in US small caps, we've seen a 5-fold increase in the last 10 years. So $10,000 through to about 46,000 over that period of time. So, and these are in the portfolio in small amounts because we know they grow better than the bigger stocks, but with more volatility. The bigger stocks being the global leaders, which we own as well, pretty flat for the year, up 0.2%. And this is the Apples, this is the Microsoft, this is the Amazons and the Googles, as well as the top 100 companies in the world. Incredible return once again over the last 10 years, with IOO up from 10,000 to 42,000 for those that reinvested, so 4 times in a decade, but a flat year. But very great companies to be holding as we recover out of this type of stuff. Emerging markets has been the sad SAC for the last 3 years with no return over the last 3 years. Still a fair return over 10 years. So anyone who invested in emerging markets 10 years ago has doubled their money. There's nothing to, that's not too bad. Incredibly cheap at the moment. Traditionally, emerging markets is countries like China, Russia, India, South America, Korea, etc. There's no Russian stocks held in any emerging markets at the moment. They're all effectively taken out for better or for worse as part of that protest with the Ukraine war. But this does include the high growth areas like India, like China. And we think it's always an important part of a portfolio because these areas provide the most growth in the long run. When we looked at that GDP chart earlier, GDP growth is much higher in developing markets, and that ultimately translates into higher growth in their stock markets in the long run, but with more volatility in the short run. Gold, as I said earlier, well, it's come off. It printed 3.6% for the last 12 months, but it's actually now just pushing back in Aussie dollar terms to slightly above where it was 12 months ago. The chart I showed you before was in US dollar terms. So this is a classic example where gold's made a loss for US investors, but a slight profit for Aussie investors because our dollar fell. Once again, great diversification benefit for our portfolio. So what we like having gold in, the reason we don't have too much gold is obviously because it doesn't produce any income. And out of all the things I've just taken you through, it's the least performer over that period of time. It also costs money to hold. The gold index, someone's got to store the bullion, they've got to insure it. So it costs money to physically hold, whether you hold it yourself, whether you hold it through an exchange traded fund like we do. So it's only given a 10-year return of about 4%. Better than cash, but certainly not as good as shares and property. On to property, and there's always that awareness of the cycle, and the cycle can be different in so many states as we've seen. But I want to talk about hand in hand with property, with interest rates. So this is a chart that on the right shows two things. The blue line down the bottom is the RBA cash rate, and you'll see that jump from 0.35 up to 1.35 that I talked about. And that takes it back almost to pre-COVID levels. And people forget that's where we were literally 3 years ago. And you'll see that's immediately translated through into variable interest rates. So variable interest rates for owner-occupied at about 3.5. You can still get 3s, you can still get 2.6. If you look for the smaller providers that are hungry for business, the big banks are all at around high 2s, 3s for first-time customers. But then as you go to the left, you'll see fixed rates are what have jumped dramatically. Fixed rates were all under the variable rate, but now they've all gone above the variable rate, with 5-year fixed rates now pushing up above 5.5 towards 6%. I don't think it's very wise to be fixing rates at the moment for those periods of time, unless you absolutely valued certainty and you just wanted to know what rates were going to be for the next 5 years. Just a quick reminder, if you're fixing a rate now at 6%, when the variable rate is 3%, interest rates would have to get to 9% over that 5-year period for you to be worse off. I really don't think that's likely. We can never say it's impossible on anything, but it's highly unlikely. And I think unless someone wants absolute certainty, variable rates are going to be the way to choose at the moment for now. But as always, talk to us, take into consideration your own circumstances. But not a great time to be fixing. I don't think the banks want that money, or they're trying to lock in highly profits there. But it's a time to be variable at the moment. This is just showing us in a different way. So trading economics, the Reserve Bank, they track mortgage rates. For Australia, they look at the 3-year fixed rate. So you can see that even though the cash rate in Australia has only gone back to where it was in 2017, the 3-year fixed rate that the Reserve Bank tracks is way higher than it was even before COVID. So this looks like an aberration. It looks like a fear-based thing around the potential for higher inflation. And I think we'll see these high rates come back to around the 4s to 5s in the next few months, and potentially back towards the 3s. I think we'll settle at about the 4 to 5% mortgage rates in the longer term. which is not unusual for anyone who's had properties and mortgages for a long period of time. It just hurts after seeing rates so low at about 2%. But for most of us, we kind of knew that was a unsustainable position that would never be around for long, except for Clive Palmer with his we're going to keep interest rates at 3% forever promise, but everyone knew that that was totally unachievable. So immigration numbers, or arrivals and departures at least, climbing up. Last month it's jumped again. So we're almost at 50% of pre-COVID levels. There's lags in departures and arrivals, so it's hard to know what net migration is yet, and the ABS should have some numbers out on that shortly, but we're certainly seeing a return of people to Australia. We're also seeing Australians travel, so that's reflected in these numbers. The fact that it goes up slowly over time normally tells us the immigration story. We'll see how these numbers develop. But this is important for property prices, because if we have people coming to the country, that keeps the market full of people looking for rentals in an already tight market and people looking to buy. I saw a stat during the week that talked about how inquiries of people looking at Australian rental and sales markets from overseas is spiking at the moment. So in theory, there's lots of people from overseas looking at our property market, assuming they're looking to buy or rent as they come to Australia. We'll see how that translates. So what have prices actually done? There's all this talk in the media about how property prices are going to potentially crash. And I just don't see it with all the dynamics that we've got. I don't think interest rates are going to be as bad as many think. And I think the immigration levels will support a reasonable floor on the property market. I was in Sydney twice in the last week and talking to friends down there. Sydney's still the tight market. And you'll see the numbers here when you look at the figures for the last 12 months. Sydney still went up last year. Albeit it only went up by 2.5%. In the last month, it went down 1.9%. So it's trending down, and you can see the average of all the 5 capital cities in Australia has come off. But this is averages are bad numbers in Australia because the cities are so different. And you'll see, Sydney houses that are around just over $1 million, Canberra actually more expensive than Sydney. So, which is interesting. But you've still got markets like Adelaide and Perth, which are well and truly sort of almost half the value of Sydney, and that causes interstate immigration. So those markets are still looking really well. Brisbane's solid with Olympics coming up. So I think we're just seeing a return of more normal property conditions. And I know from clients who are selling properties, it's taking longer, but it's back to the more normal longer. When you sell your property normally, you'd expect it to take 2 or 3 months. But it was down to literally 2 or 3 minutes or 2 or 3 weeks. So we're just seeing more normal returns in property. We will see it come off a little, you would think, but certainly not. I think some of the bank economists were talking up to 30%. They got it totally wrong coming into COVID as well, where they were calling it back that much and it actually went up 30%. So economists traditionally make bad forecasters or bad investors. And it's because they're stuck with data and all sorts of things. They don't live necessarily in the real world. And not all economists are cut like that. There's some that are more practical. But watch this space. Heron Todd White, the property clock, now the orange coloured text here are places that have changed. So we can see that Sydney and lots of coastal New South Wales is now starting to decline. We can see the peak. Brisbane's moved to a peak, according to Heron Todd White. And keep in mind, even in Brisbane, there is multiple markets. So the markets of Logan and Redcliffe could be very different from the Ipswiches and other bits and pieces and Newstead. So there's always multiple markets right down to street level. In theory, here on the Sunshine Coast, we're still going up. Places like Newcastle, still going up. Adelaide, Barossa, so South Australia doing well, as is regional. Western Australia, Broome, Port Hedland. So still money to be made for people that have the right time frame and the right structure of their investments. Units much the same. So the national property clock for units, the same areas pretty much, but including Illawarra. So mostly New South Wales and Melbourne units on a bit of a decline. It'll be interesting to watch units in Melbourne and Sydney as immigration returns. They were the hardest hit, particularly inner city units, as people wanted more space during COVID. So these things will work their way through. So wrapping up, as always, just our fundamental core belief that the best investing decision made as part of a real financial plan, which is where you've got your goals based on your life and your own specific circumstances. Portfolio designed to hit those long-term goals, not to predict or work out what's going to happen in the short term, but to deliver the returns you need to hit those long-term goals. By definition, we take a long-term view and we do all the boring stuff, diversification, getting the asset mix right, and having enough backup that you can ride through these ups and downs. And that's with our reserve strategy for our retirees, dollar cost averaging for our clients still building their wealth. And as always, the reminder, there's only 3 ways to lose money, and that's panicking and selling. It's having to sell or not being properly diversified in the first place. Thank you as always for your attention. I know your time's valuable. We get good feedback here on this stuff. For some, it probably goes a bit longer than they would like, and it's a bit more complicated. For others, it's probably a bit shorter and less complicated. We try and strike a happy medium. I'm always happy to feature any hot topics. So if you've got anything you want me to dive deeper on in the coming months, please feel free to let me know via an email or let the team know, and happy to talk about this stuff and dive deeper when needed. Have a great day, a great month as we come past the middle of winter, and I'll talk to you next month. Rob McGregor signing out.